Hey everybody, welcome back. Thank you for joining. My name is Matthew. Recently, Natalie Brunell tweeted that she would like some chart assistance for graphing a few different metrics from the US and putting them all together. Thanks to user Road Vampire for pinging me to this question that she had. I made her a chart, posted it on Twitter. I'm not sure actually if she used it or not, but I figured it's actually a good exercise for me to just go through here, because these are some very typical metrics that one might think about. She wanted to go back to 1971, obviously for the closing of the gold window, the Nixon shock. Most of my stuff also goes back then, but it even goes to the end of, or the beginning of that decade, the end of the 60s, December 31st, 1969. I think that's just a good break to start a lot of these metrics, and that's what I do for my monetary base updates. Nonetheless, we'll go through it right now, okay? We're going to compare, basically, this is corporeal growth, this is real growth of real things that are measured by the Bureau of Labor Statistics, the Federal Reserve, of course, and some other things. And we're just going to see how fast they grow, all right? A very simple exercise in this video. And in fact, this is a good point, because this is what I try to do all the time with my work, all right? We're going to talk about CPI here. It's the last metric that I'm going to put on the screen. But I think CPI is a terrible way to think about your life, to think about everything. This is something that grabs the headline news of every business news channel every month and every quarter when these things are published. But I think that it's a terrible way to look at how your own wealth grows, how you can protect your family's wealth. As many people in Bitcoin land know, inflation, that is price inflation, is a vector. You cannot get it down to one number. Everybody has different lives. Some people have kids, some people don't have kids. Some people are going to school, some people aren't. Some people have cars, some people don't. It's a terrible idea to try to get inflation, that is price inflation, which isn't even the traditional definition of inflation. Of course, the traditional definition of inflation is an increase in the supply of money. Nonetheless, it's a terrible idea to try to get to one number. And I've said this a few times before, but I'll come back to that at the end of this video. So having said all of that, let's get to the chart, okay? So the first thing that Natalie wanted to see was median family income. Okay, so this is something that, again, Bureau of Labor Statistics, published by the Federal Reserve. You can look at wages as well. There are a lot of different ways that they slice and dice this. Median family income, I think, is good enough. Okay, so this is typically, if you looked at all the family incomes based on tax returns, based on data that they see, what's the median household income? That is, if you took all of those incomes and lined them up in a row, average would be calculating them all divided by the total. That can be skewed often. But if you look at the median, that is, what is that number that is right in the middle of all the values that we have lined up. Okay, so median family income, what's the change in that in the last 55 years? Okay, and again, to make these things comparable, to understand them, don't look at the indices that they give you. Don't look at the values that they give you. Make your own index based on the time period that you want to look at. So Natalie, like I said, wanted to go to 1971. I'm going from December 31st, 1969 as my starting point. So every value that we're going to look at is set to a value of 1 at December 31st, 1969. And as we move forward in time, we're going to see just how much larger the amount is, or the stock is in certain cases, than it was in 1969. All right. And you can see already on the left-hand axis, the max here with this particular item is only 12x. Okay. So again, this is a pretty boring metric. It just comes out once a year. We see from 1969 to the GFC, 6.5x. That means on the eve of the global financial crisis, median family income was 6.5 times higher than median family income in the United States 38 years before that. Not actually a huge drop, but definitely a lull in the 5-6 years after the GFC. Then it grew again from the midpoint of last decade until the midpoint of this decade, where we are now. 10.7x, all right, as of December 31st, 2023, median family income 10.7 times higher than December 31st, 1969. That's the first metric. Next metric we're going to look at is median sales price. And by the way, all of the codes for these metrics I'm going to put in the description, as well as the links to the Federal Reserve's website. So if you want to see these for yourself, no problem. This is US data, widely available, no problem. Now, median sales price. Okay, so this is actually for houses that are sold. What is the median sales price? Again, if you looked at all the houses that were sold, stack them up in a row, pick the one in the middle, that is the median, not the average, the median. All right, so this is supposedly a more egalitarian way to look at statistics. All right, here it is now. Grows higher. Okay, so immediately you should be able to understand that assets, at least as far as houses, grow faster than income, which people need every day to feed their families, or to use a George Bush euphemism, put food on your family. The income in that description is in green. The asset value or housing value is in blue. We can see that it grows faster. Okay, a little bit higher to the GFC. It had grown 10x. Median house price sold on the eve of the GFC, down, way down to about, well, not way down, I should say, 8.9x. Post GFC even. And now back up, especially with the COVID inflation, massive construction boom from 2020 as people had to basically move out of cities because of draconian laws. We're up to now 16.6x. Okay, so 16.6x over the last 55 years is the actual amount that median house price for all houses sold in the United States went for, 16.6 times higher. Next one, stocks. All right. So again, just to remind you, putting food on your family or feeding your family, regular expenses, and food and energy is in this, by the way. This is not the headline random CPI that they use. This is the one that goes back to 1913. Again, I'll put it in the show notes. This does include food and energy. I'm talking about the green line for urban consumers. The blue line is an asset value, all right, the balance sheet side of your life, an asset value. And this is now the equity value, which is also an asset-like value. Remember, equity's on the right side of the balance sheet, assets are on the left side. So if you want to invest into a business, all right, invest into their assets, you can buy their stock. S&P 500, flagship for that. This is a very much of a balance sheet type item. Putting that on the chart now. Big difference. All right, big difference we can see from both, let's say, the average Joe's house price sale and the average Joe's income to feed their family over the last 55 years. You put stocks on, way different. All right, even you can see way up in the .com boom and bust, and then the 2008 boom and bust. You can see it's more volatile for sure, and also you can see it's exploded since the GFC. Again, has production really picked up that much? Debatable. All right, a lot of things have been shipped offshore. America is very much a service economy, and they're talking about onshoring a lot of stuff now, but very debatable if actual stock prices should be that high on average. And again, as most people, or you may or may not know, the FANG stocks, the very high tech stocks, even though the S&P 500 is 85 or maybe 80% of all market cap stocks in the US, the FANG stocks, I don't know the exact percentage, are just a way outsized percentage of that. So they very much pull the value of the S&P 500 up here. So regardless, quick look. 65 times today. Okay, November 2024. The S&P 500 is 65 times higher than it was in December 1969 over the last 55 years. So that's many multiples higher already than median home price growth, and even more than median family income. And now the fourth metric that I'm going to put up on the chart is the money supply. Now, Natalie didn't specify the money supply, but of course, I'm always going to use the monetary base. That is the only money supply that the government has control over. When you want to talk printing press, it's the monetary base. Only the monetary base. All right, so that, I've talked about that 1,000 times. For this video, I'm just going to throw it up. Monetary base of the United States over the last 55 years. Let's look at the multiple increase over time. Here we go. Now, before we get too crazy, and again, QE1, 2, 3, COVID, pump, all the rest. And let's just say the number, okay? 88 times higher than it was in December 1969, okay? The money supply of the United States, the printing press of the United States. All right, this is 5 trillion and change if you want to know the actual value. Before I get too crazy into talking about that versus the other things, let's just go back to pre-GFC and zoom in. Okay, so pre-global financial crisis. A few things. Let's take the monetary base off and S&P. Okay, so you do see a little bit of an increase in home prices here, which remember, home prices were a big part of the GFC, but they actually don't look crazy compared to median family income, although it's definitely higher. It seems like a little bit bubble territory. It definitely seems out of proportion to median family income. But we put on stocks and they go crazy. All right, so you should understand that the stock market is a big part of the volatility of an individual or a family's portfolio. You know, invest in bonds. If you want to be safe, invest in bonds or invest in Bitcoin, of course, but that's very volatile right now. It's being adopted. Stocks are very volatile. All right, so you can see it clearly here. You know, remember, 1987 is a big crash. Look at that. You got to zoom in back. This is zooming into, the 80s. We went from, let's just look at the multiples, 3.6x over 1969 down to 2.5x. All right, so still like a third drop, but a third becomes a lot bigger when you start looking at these multiples here. Okay, so 16x over 1969 back down to 10, 9, under 10. All right, it's still that third type of a drop, but the numbers just seem crazier, and they are crazier. And this is a component of inflation. It's a component of the markets, no doubt. But just want to show you. All right, let's zoom in still from pre-GFC. The volatility here was definitely in stocks. All right, .com right here, GFC, global financial crisis right here. When we say that real estate was a part of the GFC, it was really the mortgage-backed securities or the packaging of real estate and selling them on the open market to fools who didn't understand them in the form of money market funds, purchasing them, hedge funds, selling them to pensions funds in Norway. That all happened in the stock market. Keep in mind. All right, so you can very easily fool someone, flip your wealth into more opportunities in a liquid entity, which is the stock market. So that's where you can see the craziness. All right. Now let's look at the monetary base. Higher, but it's still not immediately clear where the craziness is coming from. All right. It's definitely a factor. 100% it's a factor. I'm not saying that it's not. But go back to the last few videos where I talked about the money multiplier of M1 money versus M3 money. You see all the craziness was in M3. Okay, so yes, the monetary base increased a lot. Yes, it was well above the increase of home prices and of food, or I should just say average household income, right? The light green and the blue lines. That dark green with the printer, it is definitely a factor. 100% it's a contributing a factor. But what is happening is that money is really not getting into, as they say, the main street. It's getting into Wall Street. All right, so that's what happened. And it is through the markets. This is why markets get such a bad word. It's through the markets that these things are truly monetized, that they're truly, they talk about the Cantillon effect, Cantillon effect, where if you're closer to the money, you make more money. But remember, that was originally the Cantillon effect came from gold. So this is not just new to today. This stuff has always happened. This is a function of markets. Those that are closer to the gold, even in a free market, they can cause volatility. So this is what happens in the markets. And again, these are licensed institutions. Banks are licensed institutions. We have a central bank, which is a monopoly. Not good. It's going to add fuel to the fire. But understand that the bubbles and these things, they were caused in asset markets. They were not caused in the George Bush food on your family market. All right, that wallet down here is just nothing's happening there. There's no risk there. There's just growing very terribly slow compared to the asset markets. So this is why you got to protect yourself. This is why you got to understand what is happening. All right, it's a function of monopoly. It's a function of volatility. It's a function of the Cantillon effect, where you are moving those that are closest to power, closest to money, are able to monetize it before you are. That's why you got to find an escape hatch. And of course, as Natalie believes, as I do, most of us believe Bitcoin is that escape hatch. All right, but this is pre 2008. Once 2008 happened, all bets were off. We see the money supply just explode. What you're seeing here is bailouts of all these money market funds, hedge funds, all these funds that had bad mortgage-backed securities. Taking a moment to remind you that this show is brought to you by Trezor, home of the original Bitcoin hardware wallet. For over 10 years now, Trezor means business in Bitcoin security and functionality. When using their wallet software Trezor Suite to connect to the Bitcoin network, you're automatically connected via Tor, protecting your identity and giving you full control of your coins in a fully open source manner, both on the software level and on the hardware level. So head on over to Trezor.io to grab your brand new Trezor Safe 5 with a secure element, as well as a ton of available accessories to back up your keys and keep your coins safe. And of course, again, continuing on with the cancel-on effect, all that stuff spills into the stock market. So the stock market as well is rising, although not as fast as money. Okay? Now, to close out this video, I just want to put one more metric. I mentioned it already, and that is CPI. Dear viewer, if I put in CPI, take a guess. All right, I'm going to give you 3 seconds. Take a guess. Where does mighty CPI, which is supposed to reflect the value of our purchasing power as published by the Federal Reserve and the Bureau of Labor Statistics, where is that going to be on this chart? Is it going to be towards the top, towards the bottom, in the middle? I'll give you 3 seconds right now. I'm going to put it in. It's going to be a red line now. At the bottom. At the bottom. So this is actually a very instructive way to look at this chart. And again, I say that with always saying I would never look at CPI in my videos. In fact, I think this is the first time I've ever put a CPI metric in any of my videos because it's not real. It's a fiction, right? I mean, inflation is a vector. You can have inflation very high if you have a lot of healthcare or education costs. You can have it very low if you don't have those things. Nobody knows. But to try to publish one number for the nation, you can just see with a smattering of other statistics here, stocks, asset prices, money, the very foundation of economic calculation, and even house prices, CPI doesn't even come close. All right. So just let's even zoom in again. Pre-GFC, CPI is actually above stocks. Maybe this is a hangover from the 70s or the 80s. Again, remember, a lot of these economists that you see the talking heads on TV right now, the old guys, they were cutting their teeth in economic theory in the 70s and the 80s. Maybe CPI maybe seemed more accurate when we were still in a gold standard or just thereafter. But after the the bailouts and the money printing, they start coming year in and year out. CPI has not changed. It has not adapted. So this tomato line, this red line, is terrible. It's terrible for you to try to understand how your life is working compared to other things that are happening in society. Are you able to put food on your family? Again, to use a George Bushism. Are you able to easily fill up your tank and pay for your kids' monthly tuition and pay your rent or your mortgage payment or whatever? CPI is definitely not factoring that in. All right. It's not even keeping up with household income from about even actually before the 90s. Let's see where it crosses. Yeah. Somewhere early 90s. It seems that household income really starts to diverge. That is the lowest other line here, the green line with the wallet, really started to diverge in the early to mid 90s. All right. And now CPI is just completely worthless. This is a worthless statistic. All right. So now I'm going to put up on the screen, and again, I'm just going to leave it here on December 2023. This is the last date where we have all 5 metrics here. I'm going to read you the compound annual growth of these values so you can also understand that. when you hear compound annual growth, just understand, kind of think of it like year-on-year average growth, but it's a better figure. It's stronger. It's more accurate. I'll do CPI last. I'm going to read them out. Median family income. It grew 4.6% per year since 1969. Median home price for houses sold in America grew 5.4% per year since 1969. The S&P 500, and by the way, this is without dividends reinvested, grew 8.1% since 1969. And the monetary base, that is the printing press of the Federal Reserve, grew 8.6% since 1969. And CPI, this almighty number that is quoted every month and week on the business news channels, which we're all supposed to think about, magically when it comes to voting and polling and in our politics. The CPI index, which includes all items, this is the one that goes back to 1913 from the Federal Reserve, since 1969 showed a compound annual growth rate of 4%. 4%, the lowest indicator on the chart. Absolutely useless. Inflation goes into assets. It does not stick around on the income statement, on the cash flow statement when you actually have to pay your bills. You got to be careful about that. And if you look at this chart, there's no way to assume that it's going to get any better. All right, so take care of yourselves. Hope you liked that video. Thanks for watching.